Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before investing.
Welcome back to Dividend North. Are you tired of standard 3 to 4% dividend yields? What if I told you there are funds offering yield from 9% all the way up to 13% safely? Today we are supercharging our passive income by counting down the top 10 covered call and leveraged ETF available to Canadians, and exactly why each one earned its spot on the list. Before we get into the countdown, if you are new here, we do deep dive data first breakdown of Canadian income ETFs every week. Hit subscribe so you don't miss the next one. Now a quick but important warning. Covered call strategies cap your upside in strong markets in exchange for that high income. Leverage magnifies both your gains and your losses. These are not set it and forget it saving accounts. They are tools, and like the tools, you need to understand what they are built for. Let's get into it. Starting off, our high yield countdown at number 10 is ticker HHIC, the Harvest Canadian High Income Share ETF. HHIC trades on the TSX and gives investor exposure to concentrated portfolio of major Canadian companies across sectors like financials, energy, telecom, materials, and technology. To boost income, the fund uses roughly 25% leverage and writes covered call on up to 50% of individual stock positions. HHIC currently pays 20-cent monthly distribution per unit, producing an annualized distribution rate in the mid to high teens based on its recent market price. Why it earned its spot? HHIC earns the number 10 spot because it combines exposure to major Canadian companies with a high level of monthly cash flow. But this isn't a traditional broad market Canadian ETF. The portfolio is concentrated, leverage increase both upside and downside, and covered calls can limit some gains when stock rallies strongly. So I see HHIC as a Canadian high income strategy rather than a traditional core holding. And number 9 is ticker call CALL, the Evolve US Bank Enhanced Yield Fund. Call trades on the TSX and gives investor exposure to major US banks through an equal weighted strategy. The call units are hedged back to Canadian dollar, helping reduce US dollar currency risk. To boost income, Evolve writes covered call up to 33% of the portfolio. The funds pay monthly distribution of 12.5 cents per unit with a trailing 12-month yield of about 10.27% as of July 31st. Call earned the number 9 spot because it combines exposure to major US banks with monthly income and covered call strategy without using leverage. The currency hedge is another benefit for Canadian investors. But remember, this is still a concentrated financial sector ETF, so if US banks struggle, there are no other sector to offset that weakness. Coming in at number 8 is ticker LMAX, the Hamilton Healthcare Yield Maximizer ETF. LMAX trade on the TSX and hold an equal weighted portfolio of primarily large cap US healthcare companies, names like AbbVie, United Health, Eli Lilly, Johnson & Johnson, and Merck. To boost income and reduce volatility, Hamilton uses an active covered call strategy with a flexible coverage ratio designed to balance yield and upside potential. The fund does not use leverage, pay monthly distribution, and currently yield around 12.29%. Why did it earn its spot? LMAX earned the number 8 spot because it combines defensive healthcare exposure with strong monthly income without using leverage. Its flexible covered call approach still leaves room for growth, while the healthcare sector adds useful diversification to a list that otherwise lean heavily towards financial and energy. At number 7, we have a Global X S&P 500 covered call ETF ticker USCC. USCC is managed by Global X Investment Canada and trades on the TSX. It gives investor exposure to the S&P 500 through an underlying index ETF. Then uses the covered call strategy on roughly 50% of the portfolio to generate additional income. The fund writes out-of-the-money call options, leaving some room to participate when US stock rises. It pays distribution monthly and currently yielding around 10%. Why it earned its spot? USCC earned the number 7 spot because it combines broad exposure to America's largest company with strong monthly income. The roughly 50% covered call exposure helps generate cash flow while still leaving part of the portfolio open to market upside. That balance between diversification, income, and growth potential is what put USCC in the middle of the high yield countdown. Number 6 goes to Global X Canadian Oil and Gas Equity Covered Call ETF ticker ENCC. ENCC trades on the TSX and gives investors equal weight exposure to some of Canada's largest and most liquid oil and gas companies. It then uses a dynamic covered call strategy, typically covering around 40 to 50% of the portfolio to generate additional income and help reduce volatility. The fund pays monthly distributions and currently offers a double-digit annualized distribution yield. Why it earned its spot? ENCC earns the number 6 spot because it combines Canadian energy exposure with strong monthly cash flow. Energy stocks can swing sharply with oil and gas prices, and the option premium can help cushion some of the volatility. You still get meaningful participation in the sector while generating income without having to trade individual energy stocks or option yourself. Quick gut check before we hit the top half of the list because a lot of viewers stop here without asking the most important question. High yield is never free. It is compensation for the specific risk you are taking on. Capped upside, leverage decay, or both. As we move into the top 5, the yield gets bigger and so does the complexity. Keep that in mind as we go, and I will flag exactly what you are trading away for each one. At number 5 is Global X Gold Producer Equity Covered Call ETF ticker GLCC. GLCC trades on the TSX and gives investor equal weight exposure to North American listed gold producers. It then uses a dynamic covered call strategy, writing slightly out of the money calls on part of the portfolio to generate extra income while preserving some upside. Gold miners can be highly volatile, which can create richer option premiums. GLCCs pay monthly distribution and currently offer a double-digit annualized yield. Why it earned its spot? GLCC earns the number 5 spot because it turns the volatility of gold mining stocks into an income opportunity. The dynamic covered call strategy helps generate monthly cash flow while still allowing meaningful participation when gold miners rally. It also adds valuable commodity exposure and diversification to the overall high yield portfolio. Number 4 is Canadian banking powerhouse, the Global X Enhanced Equal Weighted Canadian Bank Covered Call ETF ticker BKCL. BKCL trades on the TSX and gives investor equal weighted exposure to Canada's major bank through its underlying covered call bank ETF. It then added roughly 25% cash leverage, targeting about 1.25 times exposure to boost both income and return potential. The covered call strategy is dynamic and the fund pays monthly distributions. Its latest reported indicator yield was around 13.8%. Why it earned its spot? BKCL earned the number 4 spot by combining Canada's major bank with covered call income and moderate leverage. Equal weighting avoid concentration too heavily in just the largest banks. While the leverage can amplify both income and return, but remember, the leverage also magnifies losses when Canadian bank stock falls. Coming in at number 3 is the CI Tech Giants Covered Call ETF ticker TXF. TXF is managed by CI Global Asset Management and trades on the TSX. It holds a concentrated portfolio of large technology companies with major names such as Nvidia, Apple, and Microsoft among its holdings. The fund actively writes covered calls on part of the portfolio to generate additional income while keeping some participation in tech sector growth. It pays distribution monthly and currently offers a double-digit annualized distribution yield. Why it earned its spot? TXF earns the number 3 spot because it combines exposure to some of the world's leading technology companies with meaningful cash flow. The covered call strategy turns some of the technology's volatility into option income while still leaving room for capital appreciation. That combination of growth-oriented technology exposure and high distribution is why TXF ranks this high on my list. Our runner-up is the Hamilton Enhanced US Covered Call ETF ticker HYLD. HYLD trades on the TSX and holds a diversified portfolio of primarily US equity covered call ETFs, with an overall sector mix broadly similar to the S&P 500. It then adds modest 25% cash leverage to enhance both income and growth potential. HYLD's Canadian dollar hedged pays monthly distribution and its latest official annualized yield is around 12%. Why it earned its spot? HYLD earned the number 2 spot because it combines diversified US blue chip exposure with covered call income and modest leverage. That gives investors significantly more monthly cash flow than a traditional S&P 500 fund while still maintaining broader sector exposure. The trade-off is that leverage increased downside risk, and covered calls can limit some upside during strong market rallies. And finally, taking the crown at number 1 is Hamilton Enhanced Canadian Covered Call ETF ticker HDIV. HDIV trades on the TSX and is essentially an all-in-one portfolio of primarily covered call ETFs focused on Canada. Instead of holding individual stocks directly, it spread exposure across sectors like financials, energy, technology, gold producer, utilities, and more. It then adds modest 25% cash leverage to enhance income and growth potential. HDIV pays monthly and currently yield around 9.8%. Why it earned its top spot? HDIV earned the number 1 spot not because it has the highest yield, But because of the overall package, strong monthly income, multi-sector diversification, and track record of growth alongside those distributions. Rather than relying on one sector for option income, HDIV spread that exposure across several strategies, while modest leverages add another income and growth boost. For me, that balance is why HDIV takes the number one spot. Now, if you have $10,000 to spread across these 10 high-yield ETFs, what could that allocation look like? Here's one sample portfolio and the thinking behind it. First, we want a strong diversified core. We are allocating 20% or $2,000 to our number one pick HDIV for diversified Canadian covered call exposure. Then 15%, $1,500 goes to USCC for broad S&P 500 exposure. 10%, $1,000 to HYLD for diversified US covered call exposure. And 10%, another $1,000 to HHIC for Canadian high income exposure. Together, that's 55% in the broader positions. Next, we allocate 10%, $1,000 to TXF for technology exposure and another 10%, $1,000 to BKCL for leveraged Canadian bank exposure. This gives us growth-oriented technology plus enhanced income for Canada's major banks. Finally, the remaining 25% goes to sector-specific position, 10%, $1,000 to LMAX for healthcare, 5%, $500 to ENCC for Canadian energy, 5%, $500 to call for US banks, and the final 5%, $500 to GLCC for gold producers. Here's the full breakdown in one place so you can pause and screenshot if you want to study the allocation. Why build this way? Because high yield always comes with the trade-offs. By giving the broader funds the largest weights and keeping the concentrated sector position between 5 to 10% each, we spread the risk across different parts of the market while still targeting strong monthly income. Remember, it is just a sample allocation for educational purposes, not a personalized investment recommendation. So to recap, from HHIC and call at the bottom of our list through LMAX, USCC, ENCC, and GLCC in the middle, and top up with BKCL, TXF, and HYLD, and our number one pick, HDIV. These are the 10 very different ways to turn market volatility into monthly income. That's the top 10 covered call and leverage ETF and exactly how to balance them into real portfolio. Let me know in the comments which of these are you buying first. If this helped you think about income investing differently, smash the like button, subscribe to Dividend North, and I will see you in the next one.